Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the maze of corporate finance by unearthing the hidden gems in these filings. Today we're dissecting the Cheesecake Factory's latest quarterly report, and let me tell you there's a lot going on under the surface, a real balancing act between growth and debt. So what's the big picture here? It looks like our friends at the Cheesecake Factory Inc. are reporting their financials for the quarter ending July 1st, 2025. They've had a busy few months with new debt, share buybacks, and of course serving up those iconic cheesecakes. Let's dive straight into the numbers to see how they're doing. First off, the balance sheet. This is like a snapshot of everything the company owns and owes on July 1st, 2025. Total assets are sitting at a pretty hefty $3,151,904,000. That's up from $3,041,760,000 at the end of last year. A big chunk of that is in property and equipment, over $860 million, and then another big chunk from those operating lease liabilities. Now, for what matters to shareholders, the company's own money section, that's stockholders' equity. It's around $400 million. They've got over $100 million. They've got over common stock, and close to 50 million are actually out there for people to buy and sell. Remember, companies issue shares and then sometimes they buy them back. This affects how many shares are outstanding, and that really matters for how profits are divided up. Moving on to how the company performed in terms of making money. This is the income statement. For the quarter ending July 1st, they brought in $955,825,000 in revenue. That's up from $904,042,000 in the same period last year. So sales are definitely growing. And the bottom line, their net income was $54,812,000 for the quarter. That's a slight increase from $52,444,000 last year. This translates to earnings of about $1.18 per share on a basic level. That's up from $1.10 last year. Now let's look at comprehensive income, which includes things like foreign currency adjustments that aren't directly from selling goods or services. Here we see the same net income of $54,812,000. Then there's a foreign currency translation adjustment of $616,000. For the company, this means their international operations or assets held in foreign currencies changed in dollar value due to currency exchange rate shifts. It's a non-cash item, but it does affect their total accumulated other comprehensive income. This statement shows how the owner's stake in the company changed. At the end of last year, the total stockholders' equity was $443,455,000. Now, on July 1st, it's down to $400,948,000. What happened? Well, they paid out dividends of $13 million and they repurchased a massive amount of their own stock, over 2.5 million shares, costing around $141 million. This is a classic strategy to boost earnings per share and return cash to shareholders when they believe their stock is undervalued. Let's see where the actual cash is coming from and going. For the first 6 months of 2025, they generated a very healthy $135,800,000 from just running the business. This is great. It means the core operations are bringing in cash. But they are heavily investing. They spent $84,400,000 on new property and equipment. This is for expanding their restaurants and upgrading facilities. It's a sign of a company reinvesting in its future growth. They also paid off $110 million on their credit facility. Borrowing and paying back debt is a big part of managing a company. Then they brought in a huge amount, $575 million, by issuing new convertible debt, the 2030 notes. Think of convertible debt as a loan that can be turned into shares of stock later. And with that new money, they repaid almost $290 million of their older convertible debt, the 2026 notes, which included a premium for paying it back early. This is a strategic move to manage their debt structure and maybe get better interest rates. And remember that stock buyback we saw earlier? Well, close to $141,500,000 of that happened in this period. So they're actively buying back their own stock. Now into the notes where they explain all the details. They're sticking to accounting rules generally accepted in the US, which is standard. They also mention their fiscal year ends around late December, and this report covers a period ending July 1, 2025. Here's where they talk about how they value certain assets and liabilities that change with market conditions. They have these non-qualified deferred compensation liabilities, which are basically promises to pay certain employees in the future, and they valued these at $116,177,000. And there's a liability related to past acquisitions, contingent consideration, and compensation, valued at $12,821,000. This can happen when the purchase price of another company depends on future performance. Let's look at the longer 2/3 of the year. Operating activities brought in $135,800,000. Pretty solid. Again, heavy investment in property and equipment at $84,400,000, and that $110 million repayment on the credit facility. Let's break down that debt. They have a revolving credit facility worth $400 million. This is like a flexible loan they can draw from. As of July 1st, they had zero outstanding on it, which is great for financial flexibility. They did repay $110 million in the last quarter. They've got financial rules they have to follow, like keeping their debt to earnings ratio in check. They issued a massive $575 million worth of convertible senior notes due in 2030. They pay a pretty low interest rate of 2%. These notes can be converted into shares of their stock, and the conversion rate is tied to their stock price. Then there are the older convertible notes, the 2026 notes, with $69 million still outstanding. They've been actively buying these back, which can be a good move if they think their stock will go up. Here's a look at how different parts of the company are performing. The Cheesecake Factory restaurants, their main brand, have assets worth $1,600,000,000. North Italia, another brand they own, has assets valued at $434 million. And their other FRC brands, which includes things like Flower Child, have assets around $441 million. This shows they're not just a one-trick pony, they have a diverse brand portfolio. Looking at revenues for the quarter, the Cheesecake Factory restaurants brought in $683 million. Comparable sales for them were up about 1%. That means the stores open for over a year saw a slight increase in sales, which is decent in this market. North Italia is really growing, with sales up over 20% to $90 million, but their comparable sales actually slipped by about 1%. This means while they're opening new locations successfully, the existing ones aren't seeing much growth. Flower Child is also doing well, with sales up almost 35%. Their comparable sales are up about 4%, which is pretty good. And the other FRC brand saw a 22% jump in sales. Let's get into the management's own take on things. They've got the standard forward-looking statements, basically saying what they think will happen, but it might not. They warn about economic conditions, inflation, supply chain issues, and even geopolitical stuff. It's a lot of risk you need to manage. Their main strategy is all about pleasing customers through good food and service. They're focused on innovation and making sure their restaurants are top-notch. They clearly state that opening new restaurants is their #1 priority for spending money. They plan to open up to 25 new ones this year, which is a big expansion. As we saw earlier, their earnings per share are up, which is generally a good sign for investors. Here they discuss how things like interest rates and commodity prices affect them. They're exposed to interest rate changes, but since they didn't have much debt outstanding on their revolving credit facility in the last quarter, the impact was minimal. If interest rates went up by just 1%, it would have cost them about $1,100,000 more in interest per year. That's a decent chunk. They also confirmed that their internal controls over financial reporting are working well. This is important for making sure the numbers you see are accurate. And finally, the exhibits. This is where they list all the official documents that back up everything in the report. Okay, so what's my take on all this? The Cheesecake Factory seems to be navigating a complex environment pretty well. They're growing their brands, especially North Italia and Flower Child, which is smart diversification. However, they've taken on a significant amount of new debt with those 2030 notes, which will need careful management. Their strategy of aggressive expansion through new restaurant openings could pay off big time if the economy stays strong and consumer spending holds up. But that heavy reliance on debt and the ongoing risks from inflation and the wider economy mean they're walking a tightrope. They're managing their stock buybacks to boost per share earnings, which is a common tactic, but it's important to see if the underlying business growth can truly support those higher earnings long term. For now, they're showing good revenue growth and decent profit margins, but the debt load is definitely something to keep an eye on. Alright, that's our breakdown of the Cheesecake Factory's latest report. What's your take on their expansion strategy and the new debt they've taken on? Let me know your thoughts in the comments below. If you found this deep dive helpful, please hit that like button and subscribe so you don't miss our future corporate investigations. And hey, join our Discord community. The link is in the description for even more exclusive insights and discussions. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.